Without any further administrative detail, it's time to have a look at some common buy-sell structures, why we use a buy-sell, the purpose of buy-sell, how it's going to be established, and some of the things that we're going to look at as additional pieces of information we have to be aware of when structuring the buy-sell. Quick outline here. So we're going to look at why we use buy-sell arrangements, what the real purpose of a buy-sell arrangement is. We're going to look at where the money comes from to make sure that a buy-sell agreement does what it's supposed to do. We have some underwriting to discuss. Underwriting for the buy-sell can be a little more complicated than underwriting for other types of insurance products. We have a couple of concepts, the lifetime capital gains exemption and the capital dividend account, with which we have to be familiar in order to understand the buy-sell. We have to look at then 3 different types of buy-sells in detail. There we'll look at the cross-purchase agreement, the promissory note, and the share redemption agreement. Those are kind of the 3 basic buy-sell structures. And then we're going to look at some more advanced methods of implementing a buy-sell. And finally, we'll look at disability and critical illness, and specifically how we might structure a buy-sell agreement around disability and critical illness. We do have to understand as well that there's a correlation between buy-sell arrangements and the will. So hopefully it gives enough of an overview that you'd be comfortable dealing with a buy-sell arrangement afterwards, that you would know what questions to ask, that you would know what buy-sell arrangement to recommend in a particular scenario. So why do we need a buy-sell arrangement? Well, the buy-sell really should be considered as part of any business structure, whether we're looking at a corporation or whether we're looking at a partnership agreement. Joint ventures even might consider buy-sells, but certainly anytime we have some sort of business structure where there is more than one person involved, a buy-sell should be contemplated as part of the agreement that those business owners put in place. With no buy-sell arrangement in place, we are courting disaster. This allows the opportunity for the business to be sold under uncertain circumstances that are often then out of the control of the people who are involved. They might be compelled to do things a certain way, or in the absence of a buy-sell arrangement, they might be forced to do things in a manner that's not comfortable to them. It might cause them personal financial harm. It might cause them stress. It might cost them unnecessary tax dollars. There are a number of considerations to look at as to why we put a buy-sell in place. And I think as we go through the different methods of buy-sell, the advantages really do become clear. So the biggest advantage of a buy-sell arrangement is that it fixes the terms and conditions for the sale of a business in advance of that sale. It's akin to a prenuptial agreement for a business or a marriage contract for a business. So when everybody is getting along well and everybody is in good spirits and everybody's in good health, we all get together, we sit down, we write out the buy-sell arrangement, and we have then said, if this goes wrong later on, or if this event should happen later on, now this is going to cause the sale of the business or create an opportunity for a sale of the business, and everybody would know what the price will be, or at least what the formula for calculating that price will be. So we establish terms and conditions in advance, rather than having to deal with it at the occurrence of some uncertain event down the road. So it's designed to prevent conflict between the parties, and really that conflict can get spelled out in a court of law, which can be unfortunate, expensive, and time-consuming. It reduces stress for all parties involved, and often the things that trigger a buy-sell arrangement are already stressful events in and of themselves. We don't want to add to that stress with the stress of having to figure out how it is that we're going to sell or buy shares in a business. And the buy-sell is often seen as a fundamental part of business planning, that we should really have a structured buy-sell in place when we're going to a financing partner or a bank in order to acquire some sort of formalized lending. The buy-sell shows that the business owners have thought about succession planning in the big picture. That is a valuable thing for possible investors or lenders. It is the lawyer's responsibility to draft the buy-sell and to consider all the circumstances that should be covered by the buy-sell. That being said, the life insurance agent should have some familiarity with the different items that will be covered in a typical buy-sell. Obviously, some of these are of particular concern to the agent, while some of these will only be a concern directly for the accountant, lawyer, and the business owner. Obviously, death and disability are two big ones that would be a concern that the life insurance agent would be directly involved in. But as you get more involved in helping to structure buy-sells, you might find yourself helping to figure out what happens to assets in the midst of a divorce, for example, or what's going to happen as far as maybe a structured buyout in retirement for a business owner. So don't just look at death and disability, although those are good starting points, and often the life insurance buy-sell is the introduction to a buy-sell for a life insurance agent. Even that can be true for the lawyer and accountant. But these considerations, these factors are all items that we should look at when we're structuring buy-sells. You don't want to leave any of these off the table. Even where we have written a buy-sell agreement and we've taken care of all of the circumstances described in the last few slides, it's still necessary to come up with the funds to execute the buy-sell agreement. Without those funds available, we still may have the challenge that we cannot carry out the buy-sell as intended. This is not a great time for businesses to go seek financing. If they happen to have tons of cash on hand, they might be able to do this with their own resources. But typically, with an unexpected event, such as the death or disability of a shareholder, the business is going to be in a difficult circumstance. And this is not the kind of time that banks and other financing organizations will typically be generous with the opportunity to borrow money. So you'll find that businesses who go into these circumstances where there's just not the money available to execute the buy-sell, it's really not much better than having a no buy-sell in force at all. So we want to make sure that we have taken into consideration where we're going to get the money from in order to make the buy-sell work as it's supposed to. Obviously, insurance is one possible ready source of funds in order to make a buy-sell work. There are other alternatives. A business might have a sinking fund. Sometimes this is informally called a war chest. Basically, a pool of cash that the business sits on in order to handle possible future obligations or sometimes known future obligations. From an accounting perspective, the sinking fund tends to be somewhat inefficient. It's really money that's sitting in a business not doing anything. It's usually invested at fairly low rates of return and taxed fairly heavily. And it's not beneficial. It can jeopardize the business's ability to use the lifetime capital gains exemption. It can make a share valuation tricky, so that if you're trying to sell shares in your business and you have a whole bunch of cash, it's not really clear what the possible purchaser of those shares is buying. Borrowing money might be possible, but as suggested in the last slide, the ability to borrow might be limited because of the exact circumstances that cause us to be looking at how we're going to carry out the buy-sell. You might be able to issue shares at this point, but you have to consider that now you're trying to sell shares in a company where something has recently gone wrong, and it might be challenging to raise capital in that manner as well. And often raising capital in that manner can be very time-consuming. You may find that it takes much longer to raise capital through a share issue than what anybody would be comfortable with as far as getting the buy-sell agreement carried out. In addition to the usual set of underwriting concerns, where we're underwriting based on health, based on family history, based on the product being purchased, we have some financial concerns that are particular to buy-sell agreements. And in response to those financial concerns, we do have to make sure that we gather enough information that our underwriters are going to be able to make a proper decision. So there are some things that underwriters are going to look for. It's not necessarily that they're going to look for every single thing on this list. Anti-selection is a big concern here. What we don't want to have is a circumstance where somebody essentially purchases a buy-sell policy and already knows that they are going to have a problem. That is, they're using the buy-sell policy in order to create the circumstance under which somebody's going to buy the business from them. So that's a significant anti-selection risk, and for that reason we do want to make sure that we understand the motivation of the parties entering into the buy-sell agreement. History of the business, so we're going to look for typically an established history of 2 years or longer, although it's certainly possible to put a buy-sell agreement in place with less history than that. It may not be easy to do so, and certainly the underwriters will ask you to jump through some extra hoops with less history. Financial statements will be required in most cases. You're going to look for typically some current financial statements. It doesn't have to be anything onerous here. We're not generally looking for audited financial statements. Usually notice to reader or sometimes review engagement would be sufficient, which is well within the scope of most small businesses. The buy-sell agreement itself, some underwriters might want to see the buy-sell agreement, but often that can be tricky. It can take a very long time to draft the buy-sell, so you may find that the underwriter says, yes, we'll put the insurance in place as long as we have some understanding that they do have a lawyer working on drafting the buy-sell for them. But sometimes it takes months or even years to draft a buy-sell agreement. So it may not be practical to wait until the buy-sell agreement is completed in order to put the insurance in place. And of course, we do want to handle that basic risk management tool, that is having the insurance in place to make sure that everybody's going to be taken care of should something go wrong. And we don't want to wait to put that insurance in place. Of course, a nightmare scenario would be a situation in which we say, well, we're going to wait until the buy-sell agreement is written, and it takes, say, 1.5 years to write the buy-sell agreement, and during that time, one of the parties to the buy-sell becomes uninsurable. So there are a couple of concepts we have to review that are relevant as far as the buy-sell agreement is concerned. The first one is the capital dividend account. Now, it's not our intention here to cover the capital dividend account in great detail, but we do have to make sure we have at least a basic understanding. So the capital dividend account is the mechanism that allows the shareholder to receive a tax-free capital dividend. It can be created a number of ways. Two very common ways to create a capital dividend account are a tax-free portion, the tax-free portion of a capital gain, or a life insurance death benefit. Of course, the entire death benefit does not necessarily create a CDA credit. It might just be death benefit less the ACB of the policy. Once a corporation has a CDA credit in place, it can transfer that CDA credit. So we can actually take a CDA credit out of an operating company and transfer it to a holding company. And that's done, again, on a tax-free basis. So you would move typically the money and the CDA credit between OpCo and HoldCo, and that would allow the HoldCo then to pay out its capital dividend account credit to a shareholder of the HoldCo. If you want further review on the capital dividend account, there is an insurancelink.ca presentation called Shareholder Compensation, and it does cover the capital dividend account in further detail. So there are a couple of concepts we have to The other somewhat complex idea that's related to buy-sell agreements is the lifetime capital gains exemption. The lifetime capital gains exemption applies to dispositions of shares in a qualified small business corporation, which is what we are primarily dealing with here. It does apply to qualified farming and fishing property as well. Those do not have to be incorporated entities in order for the lifetime capital gains exemption to apply. The lifetime capital gains exemption may be used in some buy-sell arrangements. It's not necessary for it to be in place. We'll see in the next slide that there are some circumstances that can reduce the availability or effectiveness of the lifetime capital gains exemption. And as we work through some of the examples, we will see that the lifetime capital gains exemption, while it can provide a nice benefit, it's not always necessary. So some of the considerations that are particularly relevant to buy-sell agreements is that when we are selling shares of a qualified small business corporation, in order to use the lifetime capital gains exemption, we must have at least had 50% active assets in the 24 months prior to sale and at least 90% active assets at the time of sale of the business. Businesses that have produced or have generated too much passive assets and haven't paid enough out to their shareholders or haven't reinvested enough into their own operations jeopardize their ability to use lifetime capital gains exemption. It can also be jeopardized if a business owner is not a resident of Canada. So if we have somebody who owns a business that's doing business in Canada, but that person has retired to, let's say, the United States, or it can be jeopardized if we have a business owner who has declared exceptional losses on their own personal tax returns in previous years. It can be jeopardized if the business is doing business outside of Canada. So if the business is doing most of its business in Canada, it'll be okay. But if the business is doing most of its operations outside of Canada, it may not be able to use lifetime capital gains exemption. And it only applies, and this is what's often not well understood about the lifetime capital gains exemption, it only applies when a person, that does not include a legal person, a corporation, but only rather a person, like you or me, sells shares of either a QSBC or the qualified farming and fishing property we talked about on the last slide. It does not apply when a holding company sells shares of an operating company. So when we set up those structures where we have a holding company and an operating company together, sometimes we are bypassing the opportunity to use that lifetime capital gains exemption.